Today we would like to present our assignment, and we have chosen the company which is Internal Hotels and Resort Management Sdn Bhd. The reason why we have chosen Internal Hotels and Resort Management Sdn Bhd here is because one of the most affected sector due to COVID-19 is hospitality. This is because the government of Malaysia have put the country under movement control order and all business have shut down. Hence why we have chosen a hotel company, because it is one of the most affected business due to COVID-19.
So without further ado, I will be explaining about profile of the company. So Dato' Sarifara was the founder of Imperial Group in 1994, and Imperial Hotels and Resort Management Sdn Bhd HRM is actually the arm of Imperial Group. And this group always focus on unswerving commitment to remain among the region's leading names in hospitality and spa industry.
Now I will explain about the current economic status due to the disease outbreaks. Due to this pandemic outbreak, Bank Negara Malaysia, which is the central bank of Malaysia, stated that Malaysia's economic growth will be affected in Q1 2020. Travel and tourism and associated sectors such as accommodation are expected to be among the most affected sectors in Malaysia. Travel and tourism are a crucial contributor to Malaysia's economy, with travel alone accounting for nearly 50% of Malaysia's export trade in service.
There are few ratios under profitability ratio, such as profit margin, return on asset, and return on equity. Profit margin is how many percent of sales contribute to your gross profit. Usually, for profit margin, the higher the percentage is better. But since the company recorded a loss, the nearer the percentage to zero is better, because it shows the lesser money you lost relative to your sales. In 2017, they recorded a better profit margin because in 2017, they only lost 83 cents for every 1 ringgit Malaysia that they lost. But in 2018, they lost 93 cents for every 1 ringgit Malaysia that they lost. As for return on asset, it shows the productivity of company's asset in generating revenue. But since the company had a loss, the percentage which shows how many percent of assets contribute to the loss. In 2017, they recorded a better return on asset. This is because only 0.9% of the assets contribute to the loss, but in 2018, 14.53% of the asset caused the loss in the company.
So next is financial performance analysis, which is my part, leverage ratio. So financial leverage ratio, sometimes called equity or debt ratio, measure the value of equity in a company by analyzing its overall debt picture. In other words, the financial leverage ratio measure the overall debt load of the company and compress it with asset or equity. So this shows how much of the company asset belongs to the shareholders rather than to the creditors. So next is type of leverage ratio. The first one is debt ratio. So debt ratio is a solvency ratio that measures a firm's total liability as a percentage of its total asset. So in other words, this shows how many assets the company must sell in order to pay all of its liability. So here we can see that in 2017, debt ratio is 2%. Okay, so that means the hotel will have 75% of asset compared to 25% of liabilities in 2018. So that means shareholders can still be able to invest their money in the company as they have much more assets compared to liabilities after they pay all of their debt. So next is debt to equity ratio. So debt to equity ratio is a financial liquidity ratio that compares a company's total debt to total equity. And a higher debt to equity ratio indicates that more creditor finance is used rather than investor finance. So here we can see that in 2017, debt to equity ratio is 31% and it increased about 4% to 35% in 2018. As for this ratio, the lower is better. So despite the increase that happened, shareholder of the hotel still managed to have 65% of equity rather than 35% of liability, and that means the company have been using more of their investor to run the business rather than more of their creditors.
Now I will explain about liquidity and solvency ratio. Liquidity and solvency ratio are both terms that refer to an enterprise state of financial health. Liquidity ratio refers to an enterprise ability to pay short-term obligation, where this ratio divided into two forms of calculation, which is current ratio and quick ratio. Meanwhile, solvency ratio refers to an enterprise capacity to meet long-term financial commitments. Solvency ratio are divided into two forms of calculation, which is debt-equity ratio and debt-to-asset ratio. Since liquidity ratio have two types of calculation, which is current ratio and quick ratio, I will just explain about current ratio. Current ratio is a measure of a company's ability to pay off its current liability with its current asset. The higher the ratio, the better the company liquidity position. The way to find the current ratio is current asset divided to current liabilities. Based on this current ratio table, it shows that the current ratio for Impiana Hotel Berhad in 2018 is lower than 2017 with 0.77 compared to 2017 with 0.88. We see that in 2017, Impiana Hotel Berhad has higher current ratio than 2018, which means that in 2017, these hotels are in a better position to meet short-term liability and short-term assets. However, current ratio for both years are below 1, means that current liability are more than current asset, which can indicate liquidity problems. Okay, next is solvency ratio, debt to equity ratio. This ratio indicates the degree of financial leverage being used by the business. A rising debt of equity ratio implies higher interest expenses. The way to find debt to equity ratio is total debt divided by total equity. Based on this table, it shows that debt to equity ratio in 2017 is lower with 31.12% compared to 2018 with 35.12%. It shows that in 2017, Impiana Hotel Berhad has lower debt to equity ratio that are more financially stable business than in 2018. Is it good for a company to have a low debt to equity ratio, because companies with higher debt to equity ratio are considered risky to a creditor and investor?
Here I will explain about asset turnover ratio and receivable turnover ratio. Asset turnover is the ratio of total sales or revenue to average asset. It helps investors understand how effectively companies are using their asset to generate sales. By investors, they use this asset turnover ratio to compare similar companies in the same sector. Company asset turnover ratio can be impacted by a large asset sale as well as significant asset purchase in a given year. How to calculate this asset turnover is by total sales divided by beginning asset plus ending asset. Whereas the total sale is the annual sales total, beginning asset is the asset at the start of the year, ending asset at the end of the year. Receivable turnover ratio. The account receivable turnover ratio is an accounting measure used to quantify a company's effectiveness in collecting its receivable or money owned by a client. A highly receivable turnover ratio can indicate that the company collection of account receivable is efficient and that the company has a high proportion of quality customer to pay their debt quickly. Low receivable turnover ratio due to a company having a poor collection process, bad credit policy and the customer are not financially creditworthy. We can calculate this receivable turnover ratio by sales divided by account receivable.
Okay, next my part is about the investor equity returns. Investor equity return, which are the principle of equity return (ROE), for calculating financial performance measured by dividing the profit shareholder equity. Okay, to find the investor equity return, there are 3 steps. First step, you need to find the shareholder equity. Shareholder equity, the way to find the shareholder equity is total asset minus total liability. From this, we can see the shareholder equity in 2017 is higher than in 2018. Okay, then you need to find the shareholder average equity. Okay, to find the shareholder average equity, you need to plus the shareholder equity first in the beginning in 2017 plus the shareholder equity the end in 2018 divide 2. You can get the shareholder average. Okay, and then you can get the ROE, which are the net profit divide the shareholder average. Shareholder average, you can take from this $29 and you find the percent of the ROE. This means that Impiana Hotel Berhad rose to 38.1% in 2017 by 46.9% compared to 2018. This represents more than 50% of the company's income, with every dollar spent by the shareholder, and Impiana Hotel will prevent their business from making a 5% or less ROE with 2018. Next, you need to find the ROA. ROA is the how much income a company receive for each dollar of asset that it keep. Asset include bank, cash, receivable account, land, and real estate, machinery, inventory, and furniture. Okay. ROA is operating income divided total asset. Through the Impiana Hotel S-Bar, return on asset or ROA also report a profit of 14.5% in 2017 compared to the sharp decline of 0.903% in 2018. This made a big difference between ROE and ROA as the company took on new debt. As a result, the asset minus liability as equity decline, ROE rise, and ROA decline as asset rise. Okay.
As for the conclusion, it will be based on Impiana Hotel Berhad's strengths and weaknesses. This hotel have a lot of strength, including incredible spa service. However, the most strength that always been a hot topic is the bridge that connect the hotel with shopping mall. This strength attract a lot of customers to come, and until they are managed to have more asset rather than liabilities. However, they also have weaknesses that cannot be avoided, which is the rooms are too expensive, even for a single bedroom. As for COVID-19 problem, they might cannot cope with the challenge of global economic turbulence because of the Movement Control Order (MCO). Even if they open their business, they will not be able to stabilize their financial because the ratio of people who come and visit the hotel is higher than people who didn't come to visit the hotel. They will also face the risk of getting infected with this dangerous virus.